Hey out there, everyone. Welcome in. Welcome to another edition of Market Takes. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Thank you so much for being with us. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. Look, today we are diving deep, jumping all the way into today's U.S. retail sales report for July. We are going to be unpacking that report and talking all about the latest big piece of data on the U.S. economy. We're going to be talking about the headline number on that retail sales report, how that report stacked up to expectations, really how this squares with the new confidence that we're seeing on Wall Street, kind of across asset classes about this new expected soft landing for the U.S. economy. That was very much in doubt just a month or two ago, back in June. Now it seems like markets are pricing in that soft landing, which means continued economic growth, which means lower inflation, which means the Fed really is likely to be able to accomplish what they're trying to do, which is raise rates to curb inflation while also not seeing a big pickup in unemployment or a crash in the economy. That would be a hard landing. We're going to talk about how today's report could affect the market and what it tells us about the third quarter and what it tells us about the fourth quarter going forward as we look forward and don't look back, baby. We're done with all that. So listen, let's jump right into it. The headline number on this July retail sales report, 0% month over month gain on retail sales. That is flat versus expectations for a 0.2% gain. So we missed expectations, but only by a little bit. And we're up 10% from where we were in July 2021. So retail sales continuing to look strong, folks continuing to go out and spend and buy, but the devil is in the details on this report, so we're going to get into all those. Listen, weakness was expected coming in. We weren't expecting a big blowout number on this retail sales report, and we certainly obviously didn't get it, right? 0% change. But remember, in July, inflation was also 0.0% from the previous month. So we got a reading that's right in line with that CPI inflation report that we got for July as well. This is a big step down from the 1% gain that we saw in June, but that number was also revised lower today. So June being revised from 1% gain to 0.8% gain. So you're just seeing kind of a general come down on the retail sales number. It's not falling off a cliff, it's not dropping into negative territory, but you're seeing a kind of stall out. And if you look at the overall trend year over year, you're seeing this kind of flattening trend. Very clearly, the report is showing retail sales are kind of flattening. Look, the big thing about this report was the major drag was gasoline. If you take gasoline sales, gas prices out of this, well, the numbers look a lot stronger. And that again matches up with what we saw for CPI for July. Sales excluding autos and gas were up 0.7%. That beat expectations. And you also saw gasoline stations were the biggest drawdown, the biggest thing pulling the report back. Gasoline station sales were down about 2% this month, worse than expectations. Motor vehicles and parts were next, down about 1.6%. So really what that tells you is the declines that we're seeing, the things really dragging back and pulling back retail sales are the auto sector, the gasoline sector, all things related to that. Those are the things that have really taken off and boomed over the course of much of this year or over the course of much of last year that we're seeing really kind of moderate economy is generally holding up. So that's not necessarily a bad thing. That's not something that people should be worried about. And in fact, if this trend continues, if gas prices continue to come down, that's going to be a headwind, or sorry, it's going to be a tailwind for the economy for the rest of the year. The other big piece of this was that retail sales, the control group, right? The control group was stronger than anticipated. That excludes food services, automobile dealerships, building materials, and gasoline stations. So that number was up about almost 1%. And so again, continuing, if you take gas out of the equation, you're seeing continued pickup in sales. You're seeing continued strength from the consumer. And these are all good things as we look out at the economy. 9 of the 13 pieces of this retail sales report were higher on the month. The best was non-store retailers. That got a big boost from Amazon Prime Day, which happened in July. That's definitely something that folks, you want to write that out. That's one of these kind of exogenous events. It's not something you can count on each month. So it'll be interesting to see how non-store retailers can perform as we move throughout the year. Non-store retailers up about 20% from July 2021. So that again is a category that has showed continued strength for a while over the course of the year. Now, let's put this retail sales report in context, right? Nothing exists in a vacuum, in a bubble alone unto itself. We are seeing the housing market in recession. So the National Association of Home Builders came out earlier this week and told us we are seeing the housing market in recession. You had a reading of 49 below that marker of 50, which is the difference between expansion and contraction. You had a 49 reading on the NAHB Home Building Sentiment Index earlier this week. That tells us the housing market, which we've known for a while, right? We've seen consistent declines in existing home sales, in new home sales, in pending home sales, and we've continued to see that. And so we're now seeing what NAHB calls a housing recession. That's going to have some knock-on effects throughout the economy and something you want to keep your eye on, not just for what it says about the housing market, folks buying a house, but for what it does to rents, owner equivalent rents, CPI, all those things moving forward. The Empire Manufacturing Survey, that's basically the New York State region, the Federal Reserve. The country is divided into about 12 regions by the Federal Reserve. One of those is the Empire or the New York State region. That was down 31.3, a negative 31.3 reading in August. That's a 42-point decline from the previous month. That is a huge drop off, the second largest decline in history. Normally, those Fed regional manufacturing surveys don't make a big dent on investor screens. This is definitely one to watch. That happened earlier this week. So you might start to see an increased pickup in the decline in some of those manufacturing numbers. Definitely something to look out for. Like I talked about, housing. Again, housing starts were down 10% in July. Single family housing was down 18.5%. Multifamily housing up 18%. What does that tell you? It tells you individuals, families, not going out and buying houses, developers, investors, those big money private equity funds and things like that, they're continuing to buy and continuing to invest in the housing market. We'll see how that winds up. We also saw another decline in mortgage applications just this morning from the Mortgage Brokers Association, the Mortgage Bankers Association, excuse me. So again, we're seeing more weakness in the housing market, and that could have more of these knock-on effects. Housing spending, it's one of those things that doesn't just impact housing prices, like I said. You see this in retail and home furnishings. You see this in places like Target, Walmart, Lowe's, Home Depot. Because if you're not buying a new house, well, you're not buying things to furnish that house or to make improvements or repairs on that house. And so that kind of can have a snowball effect throughout the economy. General merchandise sales and clothing sales were the next two biggest laggards on the month. Third and fourth weakest categories that we saw for this retail sales report. So again, something to watch out for as we look forward. Remember though, as we're seeing this decline in housing, decline in gas prices, we are seeing a decline in CPI and PPI, the Consumer Price Index, Producer Price Index. That's what consumers are paying, you and I, when we go to the store, as well as what those businesses are paying when they buy those goods to sell them to us. That PPI report, Producer Prices, has been a bit of a harbinger of what's to come. And so you can really start to expect, there's reason to have optimism, that inflation could be starting to see a secular decline here, and we could consistently start to move lower. That's what you want to see. You want to see those price increases slowing down on a consistent basis moving forward, and we're seeing more signs of that. So prices flat. That's telling us, this retail sales report, that U.S. consumers are keeping up with the overall trend in inflation, not working against what the Federal Reserve is doing, raising rates and making things more expensive in the economy. So we have some consistency there. One thing that I wanted to highlight was a report from James Knightley. He is the chief international economist at ING. He had a really interesting report that came out last night. Just want to read a couple short passages from that because he's worried, okay, Q3 looks like it's going to hold up. We're going to see strong economic growth in the third quarter in contrast to that weak growth that we've seen through the first and second quarter. But what about the fourth quarter? Well, he says, we strongly suspect consumer spending will be lifted by the cash flow boost caused by the plunge in gasoline prices and decent employment gains. Trade will be supportive too. Inventory is less of a drag, and now that we know that manufacturing is rebounding. Putting this all together, he's expecting 3% growth in the third quarter, so versus the third quarter of 2021. They say that's firmly in the cards. The worry is what happens in the fourth quarter. And he says we're closely looking to see if this decline that we saw in the Empire State Report, which again, the second biggest drop on record, is replicated in the Philadelphia Federal Reserve Report. We get that Thursday, and the Richmond Fed Report, we'll get that Wednesday, as well as others later this month. Even if it's an aberration, there are reasons to expect weaker activity as we move forward into the fourth quarter. You've got a China slowdown, a likely recession in Europe, and those are going to weigh heavily on the global economy, which again reverberates into the U.S. and is something that we really can't get out of. And of course, he points out the housing market. He says it will also act as a major headwind. Definitely something to keep in mind. Look, let's check out the market right now, and the market reaction we're seeing broadly negative. You've got the NASDAQ down about 1%, the S&P down about half of that, and the Dow down about half that, and the S&P down by about 0.7%. Let's look at the bond market, because I think that's going to really tell us what we need to be looking at. You're seeing yields, bond yields up kind of across the board, more pronounced at the shorter end of the curve than at the longer end of the curve, which basically tells us that the market is not pricing in more inflation, that you're seeing that long-term inflationary outlook kind of brought in just a little bit as yields rise and bond prices fall kind of across the yield curve. As we look out at currencies right now, you're seeing the euro up, you're seeing the dollar up against the yen, you're seeing the Swiss franc, Canadian dollar, kind of a lot of these things rising right now. The overall thing that we've seen is dollar strength coming off the board. Over the past couple weeks, we're seeing the dollar lower. It is a little bit higher today. It's up about 0.2%, even as the euro is up. So that tells you that against other currencies, the dollar is moving higher. A big reason that we're seeing, I think, a lot of that weakness in the stock market that we're seeing right now, and the moves in the bond market, is this UK inflation report that we got this morning. We got a couple different reports on inflation from the United Kingdom. Their version of the CPI, the Consumer Price Index, up 10.1% year over year. That was stronger than expected, and a new multi-decade high over there in the UK. UK producer prices, their PPI and CPI come out on the same day. That rose 1.6% on the month and 17% on the year. That was above expectations. Also in the market, we're seeing Target having a much weaker than expected quarter. Prices, or their profits, declined by about 90% as it slashed prices to get rid of a glut of inventory. We've known for a while that inventories have been a problem. However, Target maintained its outlook for the whole year. So again, that's a good sign for the long term. Right now, the short term, not looking so great. So look, let's step back. Let's take a step back. What did we learn today from this retail sales report? Well, we learned that consumer buying has continued. We learned that gasoline is coming down, that sales of gas are dragging down the overall increases that we saw. If you strip out gasoline, if you strip out the auto sector, two things that boomed and shot up very high in price last year and early into this year, well, those are coming down. Prices are coming down there. And overall, as you look out at the retail sales landscape, consumers still buying, still going out spending money. You're not seeing a significant pullback except in those gas and auto sectors. That's a big thing. We know that the market did not like the jobs report, which was very strong for July. We're seeing really a continuation of trends. Inflation coming down, jobs continue to be strong, and consumers continue to spend as gas prices go down. This is probably not going to change the market's mind right now about the bullish theme of a soft landing. The retail sales report today really tells us, all right, you know what, not too hot, not too cold. This is just about right. It doesn't change the narrative. Even though we are seeing some weakness in the stock market right now, you could expect that to reverse course because we did not see a break in the trend from this report. So again, that's what's holding up. Here's what to look out for next. Today, later today at 2 p.m. Eastern time, right here, we are going to get the FOMC minutes, the minutes from the Fed's latest meeting, or from its July meeting. That's the word that we're getting on, the official minutes from that meeting. We'll get those later today at 2 p.m. Markets' eyes will be very closely watching that. That could tell us a lot about what's to come for September, what their expectations are. Again, the Fed has kind of moved from forward guidance to data dependent, saying, hey, what the data tells us, that's how we're going to react. The data we got today didn't tell us that much has changed on the overall theme. We get the personal consumption expenditures report. That's the Fed's favored measure of inflation. That's coming out next week. And we will also get the University of Michigan's consumer sentiment report next week on Friday. We are going to be doing another live stream on that, so please tune in. Make sure you don't miss that. That's going to be a big report because consumer confidence, consumer sentiment is the next big frontier that could change the trajectory of the market or really reinforce the bullish soft landing narrative that we've got right now. So we'll be unpacking all that next week. Listen, that's going to do it for us here on Market Takes. I appreciate you joining me. I am Dion Rabouin, reporter for the Wall Street Journal. Thank you for being with me on this edition, and join us next week when we unpack the Consumer Confidence Index or Consumer Sentiment Index from the University of Michigan next Friday. All right. Thank you for joining us. We'll be back next week. I hope to see you there.